Restaurant Brands taking a hit from disappointing same-store sales from Burger King. The burger chain has been trying to make a comeback in the U.S. after lagging its rivals for years. The biggest part of the turnaround plan was leaning into the Whopper and renovating its restaurants. There was one bright spot in the report, though. Fried chicken is still king. Popeyes was the only chain to beat expectations for same-store sales growth. You might remember Popeyes recently overtook KFC as the #2 chicken chain in the U.S. So chicken or burgers, where should the company focus its future? Let's bring in Gregory Francfort, who is the Guggenheim Securities senior analyst, to discuss this. Let's start there. Where should they focus their future?
I think you make a great point on chicken. I mean, chicken has been the brightest spot for the restaurant industry. If you look at Restaurant Brands earnings, you see what's going on. Popeyes is only 11% of profitability in the quarter, but it's growing units 11% globally. The entire business is growing 4%. So they're clearly making a bet. They're clearly driving chicken. And as a category, it's clearly been the place to be.
I'm getting hungry just thinking about all these brands right now, I will say. But let's talk about the main drivers as you see it. What are the levers that you think they can pull?
Yeah, so they brought in a new chairman, Patrick Doyle, who used to be, if you remember, the CEO of Domino's Pizza, executed a big turnaround there. One of his lieutenants at Domino's, Tom Curtis, is turning around the Burger King U.S. business. And so they're putting $400 million of capital into Burger King U.S., into the 7,000 stores here, which I think is a commitment and an emphasis on trying to get that business in a better place. It has been the weak spot in Restaurant Brands' earnings and P&L. And it's clearly a focus for the company going forward.
And so as you think about where we've seen the chicken sandwich wars transpire over the years and continue to kind of hold some ground, it seems like there has been a bit of perhaps a new reignition of innovation. How do companies innovate or reiterate on top of what they had already put out there? Is there a clear answer? Have we heard a clear way forward from companies?
No, I think it's a good point. I think you're seeing strength actually in the private companies. You're seeing Chick-fil-A and Raising Cane's. I mean, they are putting up the strongest AUVs in the restaurant industry in the fast food space. But in terms of what's public, we saw results from Wingstop over the past week where they're putting up 15% same-store sales. You saw upside clearly in Popeyes. I think in terms of innovation, I think it's a lot of companies continuing to deliver a really good value to the customer, and you're seeing good value in chicken, and these companies are leaning in there.
Greg, when you think about where the consumer is today, we've talked a lot about, yes, they are still spending, but they're starting to sort of pull back in many ways. What kind of tailwind does this current economic environment provide to a name like Restaurant Brands?
Yeah, I think one of the things that we've been thinking about is just as you've seen an increase in interest rates, an increase in cap rates, you've seen consumers lean into lower ticket, affordable ways to get an experience, and restaurants provide that. And so restaurant spending has actually held in pretty well here the last couple months and couple quarters, and we would expect that to continue in the near term. So I think that's one area of the economy that it's actually not really slowing materially. Restaurants have held in, I think, okay.
Fast food is quick, it's economic in some cases, it's a value play for some consumers' wallets, but at the same time, who is making the best case for nutrition along the way as well?
Yeah, you've got a lot of upstarts, a lot of the recent initial public offerings that have happened in this space. I mean, you've seen Cava, you've seen Sweetgreen, and I think there's been a clear emphasis on healthy. But even from the larger chains, there's been a focus on upgrading the quality of items, reinvesting into what either portion size. And so I think that's clearly been a focus from McDonald's. It's clearly been a focus from Restaurant Brands International. And that's, I think, the way they're trying to attract consumers and make sure that they're not switching to some of these upstarts as they're being basically competitively forced into this dynamic.
So we're looking right now at some of the competitor names as well. But just broadly speaking, when you think about this space, who do you think is best positioned?
We've liked McDonald's a lot. McDonald's has put a lot of capital into their system over the past 5 years. They basically, if they have 14,000 restaurants in the U.S., they reinvested in around 12,000 of them over the last 5 years, anywhere from $400,000 to $750,000 per restaurant. In a lot of cases, ripping the restaurant to the ground and rebuilding it. And I think that when a customer drives down the street and they see a fresh new asset in the ground, that matters, and it matters to same-store sales on an extended basis. And I think that's driving a lot of their success the last couple of years.
Okay. Well, you got me thinking about Popeyes chicken sandwich.
I'm ready to go.
All right. Brad and I are ordering, Greg.
We're done. Bye, Greg. See you.
Gregory Francfort, Guggenheim Securities Senior Analyst. Good to talk to you today. Appreciate the time.
Likewise.